welcome to the September 29th, 2023 episode of Watching the Tape. As many of you are most certainly aware, interest rates on money market funds and short-term treasuries are quite attractive right now. Just take a look at these yields. 5.29% on Vanguard's money market fund, or you can lock up your money for 3 months at 5.45% or 6 months at 5.55%. Parking excess cash in money markets and short-term treasuries is very popular these days. And I think it's a good idea, but only up to a certain point. I'm starting to notice a tendency to over-allocate to these short-term securities. Basically, I think that some folks are putting too much in money market funds. And I get it. When you are confronted with 5.29% on a money market fund that allows you to pull the money whenever you want versus 4.6% on a 10-year treasury, well, who wants to lock up their money for 10 years at a lower yield? Though I will say that 4.6% on the 10-year treasury is really not too shabby. Here is a chart of the 10-year yield going back to the year 2000. The last time that we had the 10-year treasury at 4.6% was October 16th, 2007, 16 years ago. I think we should go back in time to October 16th, 2007 and revisit what options investors had in high quality fixed income. So here we go, 4.91% on the Vanguard money market fund versus 4.65% on the 10-year treasury. So it was similar to today in that the money market fund yielded more than the 10-year treasury. And I also recall a similar tendency to maybe put too much money in money market funds at that time. As a hypothetical, how did the next 10 years look for the buyer of a 10-year treasury note versus the next 10 years for a buyer of the money market mutual fund? Well, it's easy to figure that the buyer of the 10-year treasury earned an annual return of approximately 4.65% if held to maturity. But what about the money market mutual fund buyer? If you recall, the housing crash and the recession of the 2008 timeframe pushed the Fed to slash rates to basically zero in order to support the economy. Here we have a chart of the Fed funds rate going back to the year 2000. You can see what happened very shortly after October 16th, 2007. All right, now let's overlay the yield on Vanguard's money market mutual fund. This is going to be in bright green. Money market yields and Fed funds rates are highly correlated. So the money market fund buyer obviously did not fare as well as the buyer of the 10-year treasury in the succeeding 10 years. Bloomberg has a function that calculates the annualized returns for any security based upon the holding period selected. The money market mutual fund buyer realized an annual return of 0.51% over that 10-year period. Investing in short-term securities exposes investors to what's called reinvestment risk, which refers to the possibility that an investor may not be able to reinvest the proceeds from a financial asset, a bond, at the same or higher rate of return as the original investment. So what's the takeaway from this little walk down memory lane? First, I have to be very careful here. I'm not making any predictions. Interest rates are impossible to predict, and be very wary of anyone who tells you otherwise. And I'm not recommending the 10-year treasury necessarily. It was just a proxy for a long-term bond in this illustration. What I do want to emphasize is that if you find yourself building up funds in money markets that would otherwise have gone into your long-term investment portfolio if interest rates were lower, then I'd encourage you to revisit your allocations to short-term funds and long-term investments. In your short-term bucket, absolutely stay in money market mutual funds to hold money for emergencies, vacations, college expenses, home renovations, and any upcoming investments. But if you start to catch yourself accumulating more than that in money market funds, then remember what your long-term investment strategy is. Because history has shown that a portfolio of stocks and longer-term bonds will give you a much better chance to grow your wealth and outpace inflation over the long term versus just simply investing in money market funds. That's it for this week. If you found this video helpful or interesting and can think of someone else who might benefit from the content, please share it. Thanks for watching. We'll see you in 2 weeks.